Hey everyone, thanks for joining me again. I wanted to share some tax planning ideas as we get towards the end of the year. It's that time of the year again. The holidays are upon us. We're not far from Thanksgiving and other holiday celebrations. And, for most people, that means let's spend some time to celebrate the holidays. If you're in my line of work and do taxes and investments and insurance, this is our time of year in which we do open enrollment and we start thinking of various things we should be doing across our clients for tax planning considerations. Because as you may or may not know, what you can do once you go to actually start working on the tax filing next year, for this current tax year, your options at that point in time are very limited. Well, we don't have a lot of things that we can still pursue any longer. We have really until the end of the calendar year, December 31st, to make any changes that would still go into effect and derive benefit for the tax year. So we're going to go over a number of items that are in play, or at least are going around in my head as we get towards the end of the year. But before we get started, let's make sure that you guys are subscribing to our YouTube channel and signing up for our newsletter and following us on LinkedIn and Facebook and the other social media opportunities that we have available to you. We'd love to have our following and list continue to grow. So please take a moment and be sure to do that for us. Okay, so what are a few things for you to be thinking about as the year closes out from a tax consideration? And it really is just going to depend on your situation and what's going on, because taxes vary across, professions. They across whether you're young or you're old, or you're nearing retirement, or you're in the early stages. There's really so many variations of what could be in play. But I think one thing that comes into mind, let's say, is if you're self-employed, what to do in that situation. You can either choose to advance income if you're kind of having a low income year and you think as a household, whether your business is having a low business year, or maybe as a household, you have a low income year. This could be a good year in which we try to bring in as much business as we can into this tax year and be able to have this on a cash basis, in which we call this taxable income this year, and ultimately able to get more favorable tax rates because, again, as a household, maybe this is a lower income year for you. Could be the exact opposite, though. If we've had a really good year and we've had a lot of income and we have expenses maybe into the next tax year that we would like to pursue, but maybe we're not quite ready to pull the trigger on it. Maybe we'll go ahead and pull that trigger and go ahead and accelerate those expenses into this year so we can use that to go against any of that other income. In particularly, if you're in a capital intensive enterprise, there are, lending institutions that like to lend for what's called the Section 179 deduction. That's, a depreciable asset, something usually like a vehicle, equipment, or software that you can write off in full. And so you may not pay for it in full. Maybe you take out a loan or financing to acquire this thing, but you can write that cost off all in full against this taxable income and help lower your tax bill, which may eventually help you to go and pay for the item. You could also, as if you're self-employed, be thinking about retirement account contributions, or setting up maybe something like a solo 401k or a 401k. There are some startup credits available to you for those activities. Now, whether or not you've got staff support, employees, or contractors, that in particularly employees, maybe you would do a solo 401k versus a more conventional 401k. Regardless, there tend to be credits. You need to set up a call with us to go into the details, but there can be credits available to you to cover at least the early year cost of such a plan. And then, really, depending if you're heavily self-employed and we have, the qualified business income deduction that's in play, and you're a service professional, you may see yourself as a household, if your income's high enough, phasing out of QBI, as we call it, qualified business income deduction. So if your income as a household is exceeding, let's say, $350,000, that's net profit taxable income. So that's not how much your business grossed, but how much you're able to, take home, so to say, after expenses. If it's over $350,000, we may start to see you phase out of QBI. And so, from what I just shared earlier about advancing income or advancing expenses could make a lot of sense. But QBI is also adjusted by maybe charitable contributions. So let's pivot to that a little bit. If you're charitably inclined and you're thinking of ways to get the most maybe out of your charitable contributions. What are some tax benefits? What you'll need to be looking at is whether or not you'll be itemizing this tax year. So to itemize would be things like medical and dental expenses. If we have enough of those, potentially we can see a tax deduction there. Admittedly, you do have to have quite a bit in order to see any tax breaks. But if we've had a year in which there's been a lot of medical and dental out-of-pocket expenses non-reimbursed, then potentially we'll be itemizing. More so, if you own a home, you have mortgage interest, property taxes, or you're living in a state that taxes you as well, we're probably looking at the state and local tax limit of $10,000 that you might be being able to deduct. And then if you own a home too and you have a mortgage on that property, depending on the size of the balance of the mortgage, we would have maybe some interest that would be deductible. And then along with that, we would have charitable contributions. There are miscellaneous itemized deductions that in some situations we still see applicable, but the big one would be really charitable contributions. And both at the federal and then the state and maybe even at the local level, we'll see tax benefit for those. The reason why that's impactful is if you're self-employed and we have QBI and we're potentially trying to minimize the phase out of QBI, there's a particular stretch with qualified business income deduction where as that phases out and as your income goes up, you get kind of taxed rather heavily. And if you're on the other side of that piece of it and there's nothing you can do to be on the other side of the threshold, then it is what it is. It's probably not worth any aggressive tax planning. But if you find yourself in that phase out range, besides business expenditures to pursue, charitable items can be rather beneficial to you too and derive a lot of tax benefit. And the exact marginal tax benefit will be dependent upon your situation, but maybe could see as much as 50 to even 60% marginal tax rate savings, specifically if we have the combination of charity and QBI. For charity, another thing for consideration, a lot of people think of giving cash to a charity, could consider giving appreciated stock as a donation. Benefit there is if you were to take that stock and sell it, you'd have to pay taxes on the growth of the stock, the appreciation in capital. But if we donate that appreciated stock to the charity as stock, not as cash, and then the charity goes and sells the stock as a nonprofit, they don't have to pay any taxes on that appreciated stock. And so they get the full benefit of the cash. You get the full benefit of the tax deduction, and you don't have to pay any taxes on the appreciation. So definitely, if you're charitably inclined, don't always think of giving cash to the charity. Consider a stock donation too, if you've got some money set aside in a taxable brokerage account, and that's done well for yourself. Other items to be thinking about would depend on your age, but maybe if you're a little older in life and we're getting towards retirement and we're starting to think of pulling or paying Medicare, we're just a few years from Medicare. This would be age 63 or so. There is the Part B of Medicare that starts to see an increase in monthly premium costs that is fixed and stays with you throughout the rest of your life. So we'd want to minimize any taxable income coming into those last few years to minimize that premium. This is planning against IRMA, as they call it. It's an income retirement account adjustment, I think is what it stands for. But that goes back 2 years prior to going on to Medicare. And so usually we're thinking of maybe doing some Roth conversions for folks as they get maybe in some low income years in retirement, but would want to keep IRMA in mind as you come into that 2 years in advance would make sense. Flipping this, going the other way, let's say you've got some large bonuses that you've received for the year, maybe RSUs or ISOs. RSUs would be restricted stock units, equity compensation. Might see this is more in the tech space rather than amongst the medical field, but might see incentive stock options too, ISOs. There can be some important planning that potential purchases, especially of the ISOs, to take place here before the end of the year to try to take it, get as much of that to clear now and to minimize what would be called alternative minimum tax. But even if ISOs aren't in play, let's just say you got a really large bonus or you get these large quarterly production bonuses or you get these RSUs, the withholding on these can tend to be off, especially on the federal level. We're only setting aside maybe 22%, not uncommonly, in federal taxes on that. But if your tax rates are high enough, let's say you're in 35% tax rates, 22% isn't enough on those RSUs. And if that gets to be a rather large portion of your taxable income, people will find themselves unfortunately surprised when we go to file your taxes and you owe quite a bit of money. And it's really rather simple. It's just not enough was taken out on the RSUs where it was set at 22% and maybe should have been set at 30 or 35%. So definitely large bonuses coming in play. Like, let's sit down, let's figure out where you're situated, and how's your taxable income going to fall, and what kind of tax rates are you at, and do you simply have enough withholding set aside so that we can know that now and not be surprised maybe just a few weeks before the deadline that you're scrambling to make a rather large tax payment. So those are definitely big considerations. Along those lines, if you have maybe a lower income year too, some of the planning that comes in here is what exactly, what's your taxable income going to be? And that's a taxable income that's a specific term. It's a technical term. You would look on to, I think it's line 15 of the 1040. It's the income right before we start to actually pay taxes on everything. And it's after all adjustments and deductions and exemptions have been put into play. And so, and that's where you fall. Your taxable income is where you fall in terms of your tax brackets. And we see pretty big shifts in tax rates at 2 points in time, going from the 12% tax rate to the 22% tax rate under current law. We also see a pretty big shift going from the 24% tax rate to the 32% tax rate. Relatively, that's where you're $100,000 of taxable income. You start to come out of the 12% tax rate into 22%, and then around $400,000 taxable income. Now, taxable income is not gross income. These are not the same terms. Do not think of them as the same. Taxable income is after, a whole bunch of other things have already taken place. And so it's a very specific term. But if your taxable income is getting over 100,000 or getting over 400,000, thinking about ways to keep that down low so we don't bump into that higher tax rate, because that's a pretty big shift. Again, it's 8% going from 24 to 32%, and then it's a 10% shift going from 12 to 22. And then what's just as important at that 12% rate, if you happen to be in that lower tax rate, is any long-term capital gains or qualified dividends that you have are all tax-free to you. So if we can keep you in that 12% tax rate, that's important. Of course, the numbers that I just shared with you are all presuming that you are married, filing jointly. If you're not married, or if you're single, or if you're head of household, qualified widower, there's all these different potential filing statuses. Some of those numbers, sorry, they don't apply. So I was throwing out to you the numbers for if you were married filing jointly. But thinking about filling up maybe some tax rates. Let's say you're a high income earner and you just happen to be in the 24% tax bracket, but a lot of times you're going to probably be getting up into 32, 35% tax rate. And for whatever reason, like this year is just a little bit lower of a year, maybe you had a bit of a sabbatical, took some downtime. It could make sense to do something like a Roth conversion, where we shift some money that was put aside on a pre-tax retirement account, and now we want to move it and pay taxes on it today through converting it to a Roth. Wouldn't want to maybe convert everything, but we convert some of that now, using up the unused portion. Let's say you're in the 12% or 24% tax rates. Want to use it all the way up to the point where we're about to go over into 22 or 32%. Could be a smart move to make. Again, that conversion has to happen before the end of the year in order for it to be taking effect. So I've gone over maybe one last thing I'd like to touch upon would be credits. If you're looking at making some purchases, such as an electric vehicle or installing solar panels, we're probably a little at the end of the year too late to be able to put the solar panels into effect, but certainly an electric vehicle isn't off the question. That is contingent on AGI, adjusted gross income, and then which way are you filing, separate versus joint versus single. But you may be able to still pick up a $7,500 tax credit on that electric vehicle, depending on where we think that income's falling. And some of the considerations we had with self-employment still apply even for a W-2 wage earner. Potentially if you could delay maybe receiving a bonus and pushing it off into next tax year, might be just enough of an income level. It's about $150,000 if you're single or filing separately, or $300,000 if you're filing jointly for that electric vehicle credit. We can keep your income low enough. Contributions to a 401k would help in that line. HSA contributions, FSA contributions, all of those come in to help maybe push that AGI number down. So the electric vehicle credit, something that could still pick up for this tax year. Solar panel credit, I think it's an energy and efficiency I don't remember actually what the solar panel credit is more technically called. I'd have to look at it. But we potentially, those would have to be installed. We're probably too late of the year to get that solar panel credit, but don't worry, that can still be back in play for 2025. Pretty robust credit. And then there is, home improvement credits. So this would be credits associated with insulation inside your home, insulation or doors or windows or a new furnace. Please reach out and have a conversation with us on that, because there are specific things that need to be met, but fairly good credits that could potentially renew year after year after year. So, if you're planning to fix up your house, maybe don't do it all at once. Let's just kind of fix it up bit by bit and keep picking up some of these credits year after year that are available to you. At least I think it's through 2032, 2033. So, anyhow, these are the things going through my mind as we get ready for the holidays. We're running all these various items in our head as we look over client situations and are, reaching out to clients and letting them know, hey, have you thought about this? Or let's have a conversation before we get to the end of the year. This could be a good time to do this while we still can, because we have until December 31st to do almost any of the things that I've made mention. There are some things that we can do into the springtime from January through April before the deadline, and even some things all the way through October of 2025 if we file an extension. So it's not everything is off the table, but a lot of things definitely come off the table once we go to do your once we get to the end of the calendar year. So now is the time to be doing those things. And unfortunately, if you come and reach out to us in, let's say, I don't know, February, March, and April, and ask, hey, what can we do? We can do a few things, but we can't do nearly as much as what we could have done now. So this is the time to be having that conversation. So if you're interested in meeting with us to discuss more of how we can be of help, we'd like to set up a consultation for our financial planning services. We certainly would love to hear from you, and we can start having that conversation. But in the meantime, we hope you all are doing well for the holidays, and hope you're not all thinking about these tax stuff like I am, but this is my work. This is the things that we are thinking about for you. So please reach out if you want us to take a closer look at these items for you.